A massive shakeup in the real estate world. Another Evergrande-style collapse. China South City has completely crumbled. Shareholders are in despair, with 60.9 billion in debt crushing the stock price, leaving it in tatters.
The video shows China South City holdings in Shenzhen City, completely empty, with no shops open.
This is China South City, the second trading plaza. It's completely empty in front. It's all gone bankrupt. Back then, this place was supposed to be the biggest and most powerful commercial complex in all of South China. But now, it's all gone. What now? It's all dead.
On August 11th this year, the Hong Kong High Court ordered the liquidation of Shenzhen's China South City holdings. By asset size, this is the largest liquidation of a Chinese real estate company since Evergrande. Notably, 3 years ago, Shenzhen SEZ Construction and Development Group became the largest shareholder, but still couldn't prevent China South City's bankruptcy. Since China's real estate crisis began in 2021, Hong Kong courts have issued liquidation orders for at least 6 Chinese developers, including Evergrande. On May 19, 2024, the Hong Kong High Court postponed the hearing on the liquidation petition for China South City to August 11, 2025. The petition, filed by creditor Citigroup International, was due to China South City Holdings' failure to repay about $306 million in debt in April 2024. Despite months of negotiations, China South City's restructuring plan still failed to gain sufficient support from creditors. According to China South City's disclosed financial performance, the company recorded its first significant loss since its listing in 2024, with a net loss of nearly 9 billion Hong Kong dollars attributable to the parent company. During this period, 15.7 billion Hong Kong dollars in loans defaulted, and at the end of the period, cash and cash equivalents stood at just about 40 million Hong Kong dollars. The company's total debt is around 60.9 billion Hong Kong dollars. China South City Holdings is a developer and operator of integrated logistics and trading centers, managing logistics and exhibition centers in Shenzhen, with the real estate project named China South City. In this debt crisis, Shenzhen SEZ Construction and Development Group in 2022 as its largest shareholder. Shenzhen SEZ Construction and Development Group is a city-owned comprehensive investment and financing platform established by the Shenzhen municipal government to accelerate investment reforms and promote the integration of the special economic zone. The company is fully owned by Shenzhen's State-Owned Asset Supervision and Administration Commission, with a registered capital of 34.4 billion yuan. On February 23, 2024, Reuters quoted 4 anonymous sources reporting that China South City's holdings creditors formed a group planning to sue Shenzhen SEZ Construction and Development Group in Hong Kong court over the maintenance agreement it provided to China South City, demanding debt repayment. The maintenance agreement includes the parent company's promise to provide liquidity support to its bond-issuing subsidiary, a credit enhancement measure used by Chinese companies when issuing bonds overseas. Investors also saw the agreement as a guarantee of state-owned enterprise credit. Now, this government-backed complex has become a mirage, entering liquidation.
Guys, we're here in China South City, and as far as the eye can see, all these buildings are part of China South City. It's officially bankrupt and liquidating, and now there's a chain reaction. Office spaces here are already down to 6,000 yuan per square meter. I can only describe this as a fire sale. Last year, they were going for over 10,000 yuan. 8,000 to 9,000, maybe even 10,000, but now just 6,000.
China South City has announced bankruptcy. Property owners are liquidating their assets. Offices, apartments, and commercial spaces are all being sold off cheaply. For example, this 50-square-meter apartment upstairs is only 500,000 yuan, fully furnished. Offices that used to cost 10,000 yuan per square meter are now going for just over 6,000. Commercial spaces that used to be bought for 200 to 300,000 yuan are now just 60,000 yuan each. What used to cost 1 million yuan is now going for just 200,000.
Millions have been wiped out. Even larger properties, worth at least 7 or 8 million, are gone. Entire streets with millions of yuan sunk into them are now worthless. They were once the money-making shops that people in Shenzhen scrambled to buy. Now they're the biggest joke in town. Look at this place, empty, with no one renting or even buying. It's 1 p.m. during lunch hour, and there's not a soul in sight. Hundreds of millions have been thrown away here. The place is supposed to be the biggest and most concentrated commercial complex in all of Shenzhen and South China. What you're seeing now is the tragic state of Shenzhen's commercial sector.
China South City Holdings, founded in 2002, was once a pioneer in the integrated commercial and logistics center model. Its business covered wholesale markets, warehousing and logistics, commercial complexes, e-commerce, exhibitions, living amenities, and property management. The company operates two main groups, investment development and commercial management, along with several subsidiaries, including Huasheng Commercial, Qianlong Logistics, HOBA, and China South City Microfinance. In 2009, the company listed on the Hong Kong Stock Exchange at an issue price of 2.1 Hong Kong dollars per share. Among its many projects, Shenzhen's China South City was one of the earliest, established in 2002. It covered industries such as textiles, clothing, leather goods, and electronics, with a planned total construction area of 2.6 million square meters and a projected total investment exceeding 10 billion yuan. It was designated as a major construction project in Shenzhen. Over the next decade, China South City replicated this model in 8 cities, including Nanning, Nanchang, and Xi'an. According to iFind data, China South City's net profit reached a peak of 4.5 billion yuan in the 2017-2018 fiscal year, but has been rapidly declining in recent years. The pandemic further impacted market demand, with low foot traffic in Shenzhen's China South City commercial areas, and some tenants considering exiting. Chinese media reports that financially, China South City failed to meet its 16 billion yuan sales target for the 2019-2020 fiscal year, and net profits continue to decline. Despite its core business being commercial logistics, the company repeatedly relied on residential sales for revenue. However, several of its property projects have been suspected of violating land use regulations. In 2020, the company saw extremely low customer traffic, with some commercial areas having more sellers than buyers. In the raw materials trading area, most shops were occupied, but few customers visited. An owner of a leather wholesale shop noted that business was solely dependent on orders from regular customers, with few people in the market. As China South City faces liquidation in Shenzhen, its projects in Nanchang and Nanning are also showing signs of decline. This is our China South City in Nanchang, completely empty. Not a single business here. Such a shame. Can this place even be salvaged? This vlogger explained that China South City's Nanchang location is actually quite prime, situated at the core of Jiulong Lake, and is close to Nanchang West Railway Station. The area is accessible via major roads and high-speed rail, with a total planned construction area of 4.4 million square meters, and an investment of over 20 billion yuan. It is also a key project in Jiangxi Province. However, the impact of e-commerce and the difficulty of running physical businesses significantly impacted the development. Reports suggest there may have been some debt issues and cash flow problems, with interest payments at risk. Similarly, China South City in Nanning is also in a poor state.
Look at these empty shops. Millions are poured into them over 10 years ago, and now they're silent. Take a look at these rows, all empty. Even the upper floors, 2nd, 3rd, 4th, 5th, 6th, they're all abandoned. This is the China South City Trading Center. Back then, people were fighting to get in here, eager to buy these money-making shops. Can you feel the sense of wasted opportunity here?
The vlogger mentioned that Nanning's China South City had initially promised unified leasing and operations, but after delivery, it failed to get off the ground. Business was so poor that property owners were required to pay significant management fees annually, with many experiencing financial distress due to investment failure. In recent years, China's real estate sector has struggled, and China South City's situation is just the tip of the iceberg. According to FSM One Hong Kong, since 2021, defaults on Chinese real estate US dollar-denominated bonds have exceeded $140 billion US dollars, and many companies, even after debt restructuring, continue to default. Standard & Poor's China Corporate Default Review 2025 found that one-third of companies defaulted again after restructuring. The Chinese government has long sought to prop up the real estate market with policies, but the results have been unsatisfactory. In the first half of 2025, real estate investment in China dropped by 11.2% year-on-year, with sales area falling by 3.5% and new construction area down by 20%. Even giants like Vanke are struggling. According to Bloomberg, Vanke reported a 49.5 billion yuan loss for the 2024 fiscal year, marking its first annual loss since its 1991 listing, exceeding the initial of a 45 billion yuan loss. In the fourth quarter of 2024, Vanke's quarterly loss reached 32 billion yuan, indicating accelerating deterioration in operations. Despite the government's largest ever market bailout plan, Vanke's annual sales still dropped to a 10-year low. Headquartered in Shenzhen, Vanke is known for its residential projects in first-tier cities. The market initially expected its low leverage and support from its largest shareholder, Shenzhen Metro Group, to help it weather the industry downturn. However, this proved to be untrue. On January 27th, Vanke announced a massive loss, leading to the resignation of both its chairman and CEO. On February 10th, Shenzhen Metro provided a 2.8 billion yuan loan, and Xin Jie was appointed as Vanke's new chairman. Although the backing of a state-owned enterprise provided temporary relief, it failed to address the systemic risks in the market. Some analysts believe the crisis in China's real estate market is still evolving, with no signs of recovery in the short term. More real estate companies may face liquidation in the future. For Shenzhen, the collapse of China's South City is a heavy blow, and Vanke's impending downfall is also a significant setback. However, core economic indicators, including investment and exports, continue to deteriorate. Shenzhen's economy is struggling. According to a report released by the Shenzhen Bureau of Statistics in July, the city, as the economic leader of the country and the top exporter, entered 2025 with major economic indicators losing momentum. Looking at the industrial sector from January to May, the total industrial output of large-scale enterprises increased by 3.5% year-on-year, but the growth rate dropped by 8.8 percentage points compared to the same period in 2024. From January to April, industrial profits fell by 4.3%, with 39.5% of businesses reporting losses. Let's look at the three main drivers of China's economy: investment, exports, and consumption. First, investment. From January to May, fixed asset investment dropped by 9.2% year-on-year, with the growth rate decreasing by 13.3 percentage points compared to 2024. In the first quarter, fixed investment fell by 2.1%, and in the first 4 months, it dropped by 8.5%, signaling worsening conditions. In April, state-owned investment fell by 14.2%, and private investment declined by 11.8%. The decline in state-owned investment is linked to the cash shortage in Shenzhen state-owned enterprises and the city's negative fiscal growth. According to Vanke's announcement on July 3rd, Shenzhen Metro Group, its largest shareholder, has provided 21.1 billion yuan in loans. Additionally, in February, Shenzhen's general public budget income totaled 391.4 billion yuan, a 4.8% decrease year-on-year, with growth 5.8 percentage points lower than expected. Next, let's look at export data. From January to May, exports dropped by 8.6% year-on-year, with the growth rate falling by 45.8 percentage points compared to 2024. From January to March, exports fell by 8.7%, and from January to April, exports dropped by 7%, showing a continuous decline. Freight volumes closely relied to exports also plunged. From January to April, Shenzhen's freight volume dropped by 8.6%, with rail freight falling by 19% and waterborne freight down by 12.7%. Rail freight is considered one of the key indicators of China's economic performance, often regarded as a more accurate reflection of economic reality than official GDP figures. Looking at the export breakdown, exports from private enterprises fell by 11.7%, while foreign-funded enterprises saw a 3% increase. In terms of regions, exports to the U.S. decreased by 12.5%, exports to ASEAN dropped by 14%, and exports to the European Union grew by 2%. These figures clearly reflect the significant impact of U.S. tariffs on Shenzhen's foreign trade. There are also reports of worse news circulating in the community. A blogger revealed that teachers at a high school in Shenzhen's Luohu district received only 1/3 of their May salaries. Another vlogger reported that many state-owned enterprises and public institutions in Shenzhen have not been able to pay wages for half a year, with layoffs happening in a chaotic manner. Despite the gleaming office buildings in Nanshan's tech park, many are empty or shared spaces, with places like Starbucks and McDonald's filled with middle-aged people pretending to work, spending most of the day on their computers. Some shopping malls have even been converted into vegetable markets. People are tightening their wallets and trying to save wherever possible. A vlogger in the credit industry reported that many high-tech companies in Nanshan, even listed companies, are unable to pay salaries. One employee complained that the company forced him to do unwanted tasks, effectively pressuring him to resign. If even high-tech companies are struggling, it's clear that Shenzhen's ordinary companies are in worse shape. Shenzhen is now facing the withdrawal of foreign capital, the relocation of Taiwanese businesses, factory closures, mall shutdowns, unemployment among office workers, and people sleeping on the streets. The city streets are quieter, foot traffic is down, and the metro is getting more and more empty. Some Starbucks and McDonald's locations in Futian have closed, and businesses are leaving China. In the video, many people are seen sleeping on the streets of Shenzhen, with some claiming that among them are university students.
I've been in Shenzhen for over a month now, but I can't find a job. I've got no money left. I don't know what to do. If I had known this, I wouldn't have come to Shenzhen. Honestly, it's just been a month of wandering the streets. I've got my bag, and I sleep wherever I can. Today might be my last day in Shenzhen. Tomorrow I'll leave Shenzhen and wander somewhere else. In a couple of days, I might end up sleeping in a park. I don't have a job. I worked for a few days at a factory, but now my money's almost gone. I might have to find a park to sleep in soon. I never imagined my first time in Shenzhen would turn out like this. At my age, I really feel useless. Honestly, I can't even find a decent job, and now I'm sleeping in parks. Am I a failure? I feel like I'm wasting away. Do any of you feel like this too? Like you don't even have a job? I've seen a lot of people sleeping under bridges in Shenzhen, and I might end up like them.
Regarding the withdrawal of Taiwanese capital, in September last year, U.S. think tank CSIS released a research report on Taiwanese companies titled Diversifying, Not Decoupling, Taiwanese Industry Responds to Geostrategic Risks. The report revealed that more than 57% of Taiwanese businesses are considering or have already started to pull out of mainland China. Their concerns aren't just about struggling to make profits, but also about the difficulty of taking their money out or leaving the country. Some reports suggest that the government has imposed stricter controls on corporate exits and capital flows. For instance, Taiwanese companies seeking to withdraw must go through multiple layers of filing and approval, with foreign exchange settlements facing tight scrutiny and delays. Some business owners try to quietly close their factories, but faced significant hurdles. Social media users shared that many business owners initially planned to shut down quietly, only to find their doors blocked overnight. Some Taiwanese and foreign business owners even decided to dismantle their equipment overnight and ship it out, fearing that the longer they waited, the more leverage landlords would have over them. One social media user lamented, "This city is no longer the dream-filled international hub it once was. Today, Shenzhen has become a place of high costs, high pressure, high unemployment, and low hope, low income, and low security. What some are calling a city of despair. From the outside, it may still appear to be glamorous, but inside it exudes a sense of desolation."